Hello and welcome to the briefing on Transpower's interim financial results for the 6 months ending 31 December 2012. My name is Howard Cattermole, Chief Financial Officer, and later on in the presentation we'll meet Chris Sutherland, the Treasurer, who'll talk about capital structure and funding. I'll talk us through the results, talk about our capital program, a little bit of an update on regulation, and then I'll hand over to Chris to talk about funding. So firstly, to the results themselves. Operating performance was very strong in the first half of the year. Underlying transmission revenue was up 15%, and with operating expenses only up 2%, there was a significant lift in our EBITDA and in our bottom line. On our preferred measure of profit, which is net profit after tax, excluding fair value movements, we were up from 77 to 112 million for the comparable periods. That's an increase of 45%. This slide shows a breakdown of that, the profit and how that's made up, essentially isolating the key regulatory building blocks. So moving from our revenue through OPEX, depreciation and write-offs, financing costs and taxation, which are the elements that build up to our overall transmission revenue. And they align with the building blocks that are used by the Commerce Commission in the model that it uses to set our transmission revenue, which delivers a return on assets and then allowing for depreciation, operating expenses and taxation, essentially bills to give us our regulated transmission revenue. In terms of revenue, as I said, we had a significant uplift in revenue in the first half of the year. That will carry on both in the second half of 2012-13, but also in the subsequent years as the major capital projects move into the regulated asset base, and I'll come back to talk more about revenue growth later on in the presentation. If we look at earnings, and this graph illustrates earnings and the effect of one-off adjustments we've had in prior years due to a number of one-off factors such as write-offs of property costs for freehold property that we purchased on the route of the North Island grid upgrade, and prior to that a write-off of expenditure on the Market Systems project MSP. This year to date, and as with last year, we've really avoided any significant one-offs, and we're hopeful that that picture will continue in the second half of the year and we'll have a relatively clean result and very much in line with our business planning. As a consequence of that, the board resolved to pay a dividend for the first half of 12-13 of $92 million. That's in line with the forecast that we had set out in our statement of corporate intent for 12-13. And it's based on maintaining a prudent level of FFO to interest coverage above 2.8 times. And as I said, as we're materially on plan financially, that we're able to meet the forecasts for dividends set out in our statement of corporate intent, and we have every expectation of continuing to do that in the second half of the financial year. This year, as with last year, there's an element of redistribution as we change our capital structure to a higher level of borrowings, and it's not really until next year that we move to a more sustainable level of dividends based on paying out between 65% and 75% of operational cash flow after allowing for maintenance capex. Now just moving on to talk a little bit about the capital program. Firstly, I should say that the North Island grid upgrade project, which was the largest of our three very big projects, has been commissioned. That happened in October 2012, and that is now fully operational. I'll come back and talk a little more about the North Island grid upgrade, or NIGU, later on in the regulatory section. The other two very large projects that we have are the HVDC upgrade, and that's primarily the addition of pole 3, another set of converter stations to support the link between the North Island and the South Island. That project has been subject to a number of delays, so it's almost a year late now, but we are very close to commissioning and in fact going through the testing phase for pole 3 currently, and we're hopeful that that project will be complete at the end of April, if not in May of this year. From a budget perspective, the project will come in well under the the regulatory approved amount for that project of $672 million. We will be well under that when the project is completed. The other very large project is the North Auckland and Northland project, or the NAN project, and that's essentially a project that involves laying underground cables to provide a second transmission route across the isthmus between South and North Auckland, and effectively thereby providing a transmission ring around the Auckland CBD. Again, that project is tracking well. In a budgetary sense, it will be materially below the regulatory approved amount of $493 million, and everything is on schedule for that project to be commissioned in or around December of 2013. So that will effectively see the conclusion of the major capital projects that have dominated the business over the last 2 or 3 years. Just illustrating the build-up and now the beginning of the decline in our capital expenditure, this just shows the CapEx projections or capital delivery and capital projection for this year. We expect to spend about $730 million capital in 12-13, slightly lower than our plan, partly because of some of the delays on the HVDC upgrade, but also spending a little less on some of our replacement and refurbishment CapEx, and that's coming off a peak of over $900 million in the previous year. If we look then at the longer term trend, and this graph is showing last year's business plan numbers against the draft business plan that is currently under development, so I must stress that these numbers have yet to be finally approved by the Transpower board, but it gives you some indication of the way that capital expenditure is expected to continue to decline over the next few years. And in fact, over the trend over the last 2 or 3 business plans has been for the longer term level of capital expenditure to reduce slightly each year. That's partly as a result of slower demand growth for electricity than we had previously forecast, in part itself driven by the recessionary effects of the GFC, but also through finding smarter ways of investing our capital and looking wherever possible to get full use out of the existing assets. Nonetheless, we do expect to spend on average between $300 and $400 million per annum over the 10-year planning horizon.